Hello, Seiiti Arata. So in this video, you will learn the best way to invest your money. And it is a proven strategy. It doesn't matter how much money you have to begin with. And this unique strategy will make or break your financial future. This is a quite practical video. And before you learn the technique, you need to know a few basics. What does it mean to truly invest? The first thing you need to consider is what an investment actually is. An investment operation is one that, after thorough analysis, promises safety of the principal amount and a satisfactory return. If there is no deep analysis of the risk, there is no guarantee or safety of the initial amount invested, and if there is no satisfactory return, it is not really an investment, it is speculation. I didn't come up with this definition, it belongs to Benjamin Graham, author of The Intelligent Investor. If you continue watching this video, you're going to learn three things: how to avoid losing money in investments, how to maximize the chances of gaining a sustainable income, and how to control the type of self-destructive behavior that affects most people's financial prosperity. So there is a lot to be said about investments, and this is a short video aiming to give you a brief introduction about investments. And because of this, I will avoid using technical terms and minor details that actually won't make any big difference to your development. I won't bother you with detailed calculations either, just the general principle of how investments work. You need a consistent strategy. You must understand that when you're investing, there will always be the first stage of putting money into your chosen investment, and then there's going to be a second stage when you back out of the investment. You get your money back, preferably with the proper return. You leave the investment when you sell your stocks, for example. You sell your investment and then you go buy some other financial product, or you can just use the money to fulfill a dream that has been a long time coming, or pay for your daily expenses. Take into consideration that investing is basically this. It's a big game of buying and selling. The thing that will make a big difference is having a consistent strategy that allows you to buy cheap and then sell expensive. This is how you make money from your investments. It doesn't necessarily mean that you have to be buying and selling all the time, constantly making transactions in a high frequency. Actually, you will find later that it is better to carry out as few transactions as possible, so then you can avoid those factors that can decrease your profits, such as taxes and fees that you will counter ahead. If the answer is not necessarily in how often you buy and sell, but actually buying cheap and then selling expensive, what kind of strategy should you have? How can you make sure that you're always buying cheap and selling expensive? Understand your investor profile. You need to start by knowing what your profile is, what your skills are, how much you're willing to risk, how much time you have to devote to investing and learning and waiting. You need to know what are your plans, keeping in mind that you have a certain timeline and which point in that timeline you are at the moment. You also need to know how likely it is that your plans will change over the next few years. Because of this, our financial enrichment course focuses on interactive activities that you carry out with me, so then we get to know ourselves a little bit better. You can go to the link arata.se/taboo to see more. And once you understand more about your financial profile, your investor profile, then you can create your own smart strategy. Create your ideal strategy. Based on the information of your investor profile, you will be able to decide how to distribute your money between different investment opportunities. This is what we call your ideal strategy. Just pay close attention to this word, ideal. It means it is an idea, it is a reference, it is a goal, it is a compass to guide you. It doesn't really mean that your money will always be distributed in this ideal way. It wouldn't even be possible because, as you will see, the stock market goes up and down. This is very important. The market goes up and down. So let's say that for your profile, the ideal strategy would be to distribute your investments in a way that you put 10% in stocks and you have 90% in government bonds. All right, this is the part where I promised we're not going to go into detailed calculations. Just let's keep it simple so you can understand the general principle. All right, 90-10. If today you were to manage to keep your investments as close as possible to your ideal strategy, and then tomorrow you see that because the market goes up and down, this portfolio that you have will no longer follow your ideal strategy anymore. Maybe the stocks have risen, maybe they have fallen. And because of this, they will no longer be that amount of 10% that they were the other day. If the value of those stocks dropped a lot, maybe you could have a situation in which you have 5% of your money into stocks and 95% now in government bonds. It could be the opposite. Maybe now your stocks that you bought are from companies that have performed pretty well. They're now more valuable. And when you take a look again, your stocks are now 20% of your investments and you have 80% in bonds. Can you see? This is very, very interesting. The market can fluctuate. It can change the distribution of your investments even without you lifting a finger. You didn't buy, you didn't sell anything, but just because the market goes up and down, the distribution of your investment portfolio has changed. This is the secret of successful investing. You have to continue taking care of your investments, following your ideal strategy. Remember that you had an ideal strategy, right? So in this case, you had 90% of your investment in government bonds and 10% in stocks. Now, in our example, let's imagine that your stocks, your shares, are now 20% of your money, and that caused your government bonds to be now 80%. What does that mean? What would you do next month when you get your wage and now you have more money available to invest? What are you going to buy? You should buy more government bonds. Why? Because when you buy more government bonds with the new money that you have available, you are getting closer to your ideal strategy. When you put more new money into government bonds in this situation, you are trying to get back to your ideal investment ratio that you initially set up. 90% in government bonds and 10% in stocks. But please remember, this 90-10 is just an example. It could be 50% in government bonds, 50% in stocks. If you have a lot of money to invest, you could even have a bigger range. You could have like 30% in European stocks, 20% in American stocks. You could have 10% in government bonds, 10% in corporate debt securities. You could have 10% in real estate, 10% in metal, gold and silver, 5% in crypto, in Bitcoin, and 5% in art, or any other distribution based on what you will discover looking at your investor profile. This is the important part, that you always make your choices based on your profile, and then you create your ideal strategy. So in this example that we're giving here, you're putting more money into government bonds. And when you do that, you're avoiding to buy those stocks that are currently at a quite high price. Imagine if you continue this strategy for a few months, but then something happens, you have some unforeseen event and a few months go by, you don't put new money into those investments. You're actually so busy that you don't even look how your investments are for quite a while. On top of this, you're also going to need some extra money. You're going to sell part of your investments. Imagine, and to make this example more complete, imagine that you had an emergency fund, another very important concept, and you had to use all the money from your emergency fund, and still you need some extra cash that you're going to get from your investments to handle whatever problem that you have in your life. All right. Now, you're going to take a look after a few months, right? You're going to check, and then you see that now you currently have available 30% of your money is now in stocks and 70% is in government bonds. Now I'm going to ask you an opposite question to what I asked you before. In this case, what are you going to sell? Now, if you say that you're going to sell the shares, you're right. Because these shares, they were initially 10% and now they became 30%. This means they gained value. So now you can sell them, because now when you sell them, you're selling them at a higher price than what you paid. This is a very simple principle and it works. This strategy will help us to overcome our self-destructive or panicked behavior when we are under pressure. And it also helps us to avoid being greedy when our investments are worth a lot. Make your ideal investment and then make sure that you always stick to it. Use the ideal investments ratio to decide where to apply new money, new resources among the different options in your investment portfolio. And then you always use the ideal ratio as a reference to decide how you can get closer to your ideal investment. This is very simple. I know that this explanation might seem a little bit counterintuitive for some people. Many people may say, well, it seems, Seiiti, that in that case I'm selling my winners, I'm keeping my losers. Actually, when you take a look at the numbers, what you're doing, you're buying low and you're selling high. That's all. This video has been purposefully simplified so then you can understand the fundamental principle of investing. And for those of you who want to deepen your knowledge, you're more than welcome to join us in our course, which is available in arata.se/money taboo. There are different technical details that could be explained in more depth, and we can do that in another video. For example, the importance of classifying and diversifying within each asset class, because when you take a look, for example, at the government bonds, there are many different types. You can take a look at stocks, and again you have to make a choice. How are you going to choose? When you take a look at your transactions, how can you avoid fees and taxes that will eat part of the profit that you could make? And also how you adapt to the ideal ratio, because life will go on and maybe your plans will change. There will be different moments, different times in your life, and you're gonna have different priorities, and you're gonna be more, perhaps less willing to make few risky investments. We also didn't mention in this video technical terminology such as diversification, balancing, asset allocation, ETF, technical analysis, fundamental analysis, simulations. The main message is that you need to know what your profile is. You need to know what your plans are, what you're capable of, and then you set your ideal strategy based on your profile, so then you can buy shares or bonds or any other Bitcoin or anything at low prices and sell them for higher prices. It is really that simple. Anybody can do it. I'm quite sure you will be able to make better choices with this. And if you want some extra help, you can go to arata.se/money taboo, and then you can take a look at our course.